Hey, everybody wants to know what's happening in 2026. Well, you're in luck. Today, we're going to be watching a video called 2026 Stock Market Predictions. And granted, nothing can ever go wrong by trying to predict the future. Let's watch this together from Professor G.
Everyone thinks that we're going to be in a big crash coming soon, right? Not so fast. I pulled together some articles of some huge financial institutions and other analysts to see what they actually think for 2026, and this absolutely shocked me. And after this, I'm going to explain what's probably happening next week with the Fed rate cut and how that's going to affect the stock market very short term. BlackRock also just dropped a bombshell shifting away from bonds and long-term treasuries, which is a very bad sign. My name is Nolan Gobea. My students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research.
All investing carries risk. You mean all stocks are bad? Hell yeah.
This is not financial advice, and I'm not a financial advisor. Okay, so I put together this table here, and what you can see are a bunch of these big institutions like Morgan Stanley, BlackRock, Bank of America. And overall, if we look at the outlook on US stocks in that second column, most of them are bullish or moderately bullish. Bank of America is a little bit cautious, but they still think it's going to be positive. If you look over to the next side, the forecasted S&P 500 level, Bank of America says it'll be around 7,100 for 2026. Remember, right now we're at around 6,800, so that's still positive, but that's only up 3 to 5% or so. Whereas BNP at the bottom says 7,500, Morgan Stanley at the top says 14% or so upside over the next year. Now, this is all well and good, but we want to see the key themes or drivers and even the sector bias. So looking just at Morgan Stanley, the key themes there would be rate cuts, earnings, growth, and rotations out of bonds. The sector bias there is that they favor equities broadly. For DWS, they say profit recovery.
By the way, I, I appreciate him taking the time because I know this took a lot of work to go through and put this table together. But here's the deal. Even though Morgan Stanley, Bank of America, all these places are huge, they have no idea what's going to happen in the market. Just as much as you have no idea what's going to happen in the market, right? Some of them say 7,100. Some of them say 14% higher. Nobody's going to give any answers over at DWS, right? None of them know. But people put so much stock into these projections. You don't have to do that, right? Follow the trends that are given to you, right? If you see the market trending up, by all means, ride that dude until it doesn't trend up anymore. If you see the market trending down, get out the way so it can figure out its bottom. And then when the 10, 20, 50 crosses back up, ride that dude as far as we can again. But to the point here, nobody actually knows anything.
And monetary easing. The sector bias there is cyclical sectors from rate sensitive industries. For BlackRock, they're saying AI driven investment boom, capex cycle, and rate cuts are going to be the key themes and drivers. The sector bias for them would be tech, AI, and infrastructure beneficiaries. Since Bank of America is a little bit more of like a warning tone, let's see what they have to say, which is that they have this AI air pocket, weak consumer, and valuation risks.
And what's fun too is people who leave their comments on YouTube videos, they get passionate as all get out. Oh, there's no way that SoFi doesn't take over the entire banking sector, and in 2026, the entire S&P 500 is really going to be the SoFi 500, right? Or conversely, right? AI stocks are so overblown. Palantir is going to go to zero. Nvidia is going to go to zero, right? These passionate ideas that people have around what a stock is and or isn't going to do. And as an outlier, I don't want you to ever feel compelled or so emotionally wrapped up in any one stock. And if you're watching this and you have those incredibly strong feelings, by all means, list them in the chat right now. Go for it. But you don't actually know what's going to happen, right? It's funny to me too because like I don't watch sports at all whatsoever. But when the Cowboys come on, oh, you better believe people lose their shit for the Cowboys, right? Oh, did you see Dak Johnson? I don't know his name. Dak Prescott. How great he was. Oh, can you believe that CD Lamb, CD Jones, that CD guy? Can you believe that he dropped those passes? Right? People get so passionate about football. People get so passionate about sports, and then they try to apply the same sort of fashion to their investments. And then they wonder why they keep losing money. And then they wonder why they can't seem to be successful in the market. Well, rather than marrying the stock, rather than having such passionate biases on these, how about be indifferent? The market's going to do what the market's going to do. And all you got to do is ride with it or get out of the way. Mark asked Santa to make sure that Palantir goes to zero. I mean, I'm wishing for that too, my friend.
The sector bias for them is overweight defensives like healthcare, staples, and REITs, and try to underweight tech. Okay, so what does this even mean though? So this type of research suggests 5 basic things for investors. From what I've compiled, the base case is actually moderately bullish. Many large institutions expect US stocks to deliver solid gains in 2026, supported by rate cuts, earnings growth, and growth themes like AI.
Okay. And again, I appreciate Professor G having taken the time to collaborate this and put it all together. So base case, moderately bullish. So basically, hear me out. Base case, and this is not a dig on Professor G. This is a dig at the whole we are so smart because we work at a bank narrative. The base case is probably 8 to 10% growth in the S&P over the next few years, with the key themes being, I don't know, pretty much the same thing that we've been talking about the last few years as well. Wait, what? So basically, expect average growth and expect the same thing to be happening that's happened for the last several years. Wow. Wow. Incredible thesis that these banks have come up with. Yeah.
There are diverging views on risks, though. Some are cautious, highlighting risk from weak consumer spending, over-reliance on AI, or stretched valuations, meaning volatility could rise. Now, the third thing here is that there is a sector-level divergence that's likely. Tech/AI-linked stocks may outperform if growth and investment continue, but more defensive sectors like healthcare, staples, real estate, financials also have a case if economic growth or
So basically, if people continue to invest in these new exciting sectors, then they'll do great. But if people decide to invest into defensive sectors, then they'll do great. Come on. So they get paid for that with no difference of opinion. Yeah. Isn't that funny though? And that's why I don't want you to ever worry about what these banks are putting out, right? Because they can't put out anything controversial. What do I mean by that? Imagine that I'm an analyst at Morgan Stanley and I'm like, no, I don't think you get it. Forestry products are going to be the shining star this year. Base everything or forget everything you know. Forestry products are going to be where every cent is going, right? And then if I'm wrong at the end of the year, guess who's get fired? Guess who is getting fired? This guy. So I'm not risking that. I'm not putting myself out there. I think we'll continue to grow at the same growth rate that we've had in the stock market for the last 80 years. And if popular sectors continue to do well, those popular sectors will go up in value. And if different sectors do well, those sectors will go up in value. Where's my paycheck? Where's my 6-figure quarterly bonus? I mean, really, what do you expect from these people?
or consumer spending softens. Another thing that I found that a lot of these institutions are talking up even more is that geographical investment could matter. Several forecasts signal potential upside outside the US, like specifically in Europe, which could reward investors with diversified global holdings. And all of this leads to number 5, which is just the importance of flexibility. Given mixed signals, many analysts emphasize staying diversified and flexible rather than leaning too heavily.
Case in point, right? Congrats on saying nothing. Exactly. Congrats on having no opinion, because if they had an opinion, they wouldn't have a job. Lucky Chevy has a great question. What's the Derpy Joker's opinion of the market? The market's going to be amazing next. Wait, that's too Trumpy. That's way too Trumpy. I gotta come up with a good voice for the Derpy Joker. Derpy Joker thinks that you should go all in on out of the money YOLO calls on SoFi, because the Derpy Joker heard that the SoFi CEO gets paid like trillions of dollars once SoFi hits $75 a share. So if you're buying anything but SoFi, you're not getting paid yourself, right? Because wouldn't the CEO do everything possible to make sure that he hit these bonus targets? Duh. So therefore, Derpy Joker recommends. Derpy Joker's thesis is, yeah, just buy SoFi. Don't buy anything but that. His portfolio is going to be worth billions of dollars. His portfolio is going to be so big, it's going to be worth a Brazilian dollars. That's how big it's going to be.
Into one sector or theme. I've been saying this for about a year now. If you're just relying on just AI or just tech, know that that has never worked in the history of the whole stock market. You can't rely on one sector. Make sure to keep yourself safe.
You can, as long as that sector is performing, right? As long as the sector's got the 10/20 price over 50, as long as that sector is hot, you can run on that dude for weeks, months, years, potentially decades if it comes through. But all stocks are bad, and every once in a while they act right? Let's go to like Netflix. Netflix has fallen out of favor, right? I don't know about you, but Netflix has fallen out of a lot of people's favor right here. I mean, I haven't heard people talk about Netflix in a long time, even though it had these huge moves up. If we zoom out slightly, right, it's had some giant moves up, right? Humongous moves up, even though 2022 was brutal for it. And it went from November 2021 up until July of 2024. So nearly 3 entire calendar years to get back to break even. I don't hear about Netflix all that much anymore. So like a stock like this can go for ages and be the real darling of the market, and all stocks act right, but all stocks are bad, but every once in a while they act right. It definitely acted right for a minute, but now it's not. Right? Your 10's under the 20, price is under the 50. Boom, boom, boom. Okay, let's keep going. Where's this at? Here.
Safe. Now, a lot of this information was positive, but I did come across a couple of institutions that were very bearish and actually saying the opposite, namely Vanguard, JP Morgan, and Michael Burry. But
okay, Michael Burry just closed his fund, by the way. In fact, I if I'm not mistaken, he put out a press release that was like, clearly I've not been in sync with the markets for a very long time. I'm closing my fund. And he, like, how many times do these people come out and say there's going to be a crash? If they come out and say there's going to be a crash every month, then eventually they're going to be right.
and again, when is Michael Burry not crying wolf? The most likely decline range as far as if the stock market's going to drop or not in 2026 was between 10 and 20%. For the most part, they're saying that it's going to be a correction and not necessarily a crash of over 20%. Unless a perfect storm happens where multiple different risks all hit at the same time, like rate, global shock, or a tech bubble.
Now, this lady right here is the risk of your portfolio. Don't trust this. Don't give this lady any of your monies. She will make it like evaporate.
Risk isn't uniform. High growth, highly leveraged, or AI dependent firms are viewed as the most vulnerable. Defensive sectors or diversified allocations may fare better. This is why I've been talking so much about value investing. Nobody really wants to do that right now because it's not as fun. The tech stuff and the AI stuff is going crazy, where things like SCHD or even VTV are kind of staying steady, growing at 5% or something rather than 20 or 30%. Understand.
Dude, why would I put any risk in the market at 5%? Seriously though, think about this, right? If my cash vehicle, SGov, is paying 4.3%, why would I put any market risk into SCHD or whatever the other one he is at 5%? Market risk, no market risk, roughly the same outcome. I'll go with the no market risk.
Understandable, but there are market cycles and we just need to understand that we may be shifting to a new one. So overall, if there is going to be a crash, I do believe it's going to mostly be in tech or AI, specifically the high risk type sectors, maybe even in the Bitcoin market, things that are higher risk. For those with a long enough investing horizon though, this should not be scary. This should excite you. I know that it's going to excite me to buy into those great companies at much lower prices. And one way to free up some cash in the event of some type of a crash would be from today's sponsor. Thank you to Figure for sponsoring.
Oh, come on. That was a decent roll in there. I appreciate that. Hang on. How long is this? We're gonna use our premium to jump ahead.
Crypto-backed loan with Figure today. Now is the Fed meeting happening next week. The FOMC Fed Watch tool has a huge...
Oh, I know this tool. I've been showing you guys this tool, right? You go to Fed Watch tool, and it's the first thing right there. the CME Fed Watch tool. I'm so happy other people are learning about this. I did consulting for a dozen years with credit unions, and this was like one of my primary tools to say, hey, if rates go up or down, what's the likelihood of the Fed raising rates or not? Right. That was what we based so much risk on. And what is the likelihood of them in the next year? Let's see. Let's go to December of 2026, right? So current rate is between 375 and 4, which is right here. So basically, there's currently a 99.1% chance rates will get cut. A 99.1% chance that rates are cut. And what we're saying here is basically a 90% chance of them being down at least 50 basis points. And a how much is this? 35, so 65% chance of them being down at least 75 basis points. There you go. I just told you. 100% for free. You don't have to wait for Professor G to let you know what it is. But let's see, December. So it looks like at the next meeting, there's a 87% chance of rates being cut December 10th. Oh, that's this week. That's this week. Ooh. Hey, Carolina, what's going on? Great job for you. Great job for you being here. I like seeing the back view as a member now. I like seeing it as well. Thanks for being here, Carolina.
Huge majority that believe we will see a cut next week. The reason for that is signs of a weakening labor market, which is increasing expectations for that. Recent data showed job losses. The private payroll provider ADP reported a drop in jobs, marking the third decline in 4 months. Also, total US layoffs for 2025 just passed 1.17 million, the highest since the pandemic, with November alone accounting for 71,000 job cuts. This weak labor backdrop has strengthened the case that the Fed may cut rates soon, boosting investor risk appetite. We could definitely see further upside if the Fed signals a rate cut. This will especially benefit small caps, financials, and non-tech sectors. But if the Fed doesn't make a rate cut, then we're in for a roller coaster market. With so many already pricing in the cut, a non-cut would absolutely flip the script. Markets don't crash on decisions, they crash on surprises. So if the market's already pricing in this rate cut, but Powell doesn't deliver, the reaction could be a sell-off.
Nothing personal, Professor G, but the term priced in just, I hate the term priced in. If you think about what the term priced in means in context, that means prices will never change. If it started at 100, it's going to end at 100 because everything is priced in. Just irritates the mess out of me. Nothing is priced in, right? Investor behavior is what moves prices, right? People being greedy or people being fearful pushes the prices of assets up, and it also pushes the prices of assets back down. Even SoFi, if you can believe it, even SoFi, people got super greedy, but now they're starting to turn fearful, and that's what's causing the price of SoFi to start coming down. But yeah, when I hear somebody say, and nothing personal, but when I hear people say something's priced in, it's nails on a chalkboard to me.
Specifically in tech or small caps, high valuation growth, maybe real estate or rate specific style investing, bond yields would jump and risk assets would drop fast. But we're not in for something like a huge crash, like a 20% drop or something like that, unless Powell comes out and says something like, not only are we not cutting rates, we're actually going to increase rates. If Powell simply just delays the cuts, then usually what happens in the market is that the market does have a little bit of a pullback, but nothing crazy. Historically, stocks dip on disappointment.
Actually, rather than just come up with something like it might do this, might do that, let's actually look, because I find this really interesting. In TradingView, you can actually layer in the Fed funds rate with the price of the market. Or price of anything, really. This is really cool to me. So, this, you're never going to believe this, but when rates were going up, so that means the market must crash, right? Wait a minute. Wait a cotton pick a minute here. Rates went up, market goes up. Okay, that means when rates come down, market crashes, right? Wait a minute. Rates go down, market go up. Now, granted, there are some pullbacks here and there, but rates go down, market go up. Something's not right here. Rates go up, market go down, right? Rates go down, market go up. Or is it market always go up? I don't know. But I do know that the correlation that people want to make to say when the Fed cuts rates, that's going to help the market. Or when the Fed raises rates, the market's going to tank. It's just not reality.
Appointment, yields go up, volatility spikes, but markets usually stabilize within days or weeks. Think of it like an air pocket, not like a crash. Let me hit back on that point that I said earlier. What would cause a major crash would be a Powell no cut, also with some type of hawkish message from Powell. Powell says something like, we're not close to cutting, rates may need to stay higher for longer. That's when markets break down. If job losses are rising, which they are, and Powell still refuses to cut, markets could interpret this as a policy mistake, and that's when markets absolutely go crazy and a major correction is in store. We'll just have to see what happens. I'm definitely going to keep you informed. And with that, you should sign up for my free newsletter that I just started down below in the
There you
description.
go. All right. So basically, and this is no shade at Professor G, but basically all these houses just came out, all these investment firms came out and said, well, we don't know what's going to happen. It might be more of the same, but also it might not be. And there might be some sectors that do really well, but there might not be. I'm just saying. I'm just saying. I don't want you to put a lot of stock in what these investment houses, what these people put out. I really want you to focus in on your trading plan and follow that to a T. That's the most important part of it. Even Derpy Joker would say that. Follow your investment plan to a T. Listen, if you're ready to save time, make money, start with less risk, click one of these two videos, and we'll talk soon.